welcome to. Hope everyone had a fantastic Easter. So we'll get stuck into the update in terms of where we're seeing the kind of residential markets and commercial markets across Australia. As you all know, my name is Philip Almeida, Director of Performance Property Advisory, and today the advice that we'll provide is probably general in nature. So if you do want to reach out to us, feel free to reach out to any of the senior advisory team, and we'll sit down with you and take you through your kind of personal positions. So right now, over the last, from May 2020 up until now, we've probably seen some pretty significant uplifts in the residential markets across Australia. You can see Adelaide's actually performed quite well in terms of movement, and we're still seeing some uplift on the ground in terms of some of the residential AAA rated suburbs on the ground in Adelaide. So Catherine Norris, our senior advisor on the ground in Adelaide, has reported that there's still a lot of buyer depth in terms within that, say, 800 to 1.2 price point. So we are still buying a number of assets in Adelaide. It's just that the entry point has probably been lifted from 700,000, up towards $800,000 and above. Brisbane's going along fairly well. We've seen some renewed activity in the Brisbane market. It probably eased up last year as a result of all the land tax potential changes, but we've probably seen stock levels in Brisbane are quite tight, and days on market is fairly tight as well. So from that end, kind of Brisbane's moving along a little bit more aggressively than we anticipated. Canberra, we've seen a little bit of a slowdown in terms of movement, in terms of activity on the ground. Darwin and the Perth markets are performing at fairly similar levels, we're finding, and stock levels on the ground in Hobart. Hobart's actually been a really good performer over these last kind of 18 months because stock levels are actually quite tight. Melbourne and Sydney, they've probably seen some uplift, but we're definitely seeing the Sydney market starting to slow down, and we're seeing some really aggressive movement in the rental market for both Melbourne and Sydney currently, and across all the markets nationally at the moment. So at the moment, the primary drivers nationally we're seeing in terms of supply and demand, affordability. We're obviously seeing some secondary drivers out there in the residential markets. A lot of people were concerned around interest rate movement over the last 6 or 12 months. But we're seeing some stability back in the residential markets now for the first time. So this last quarter has been really interesting in terms of our client inquiries probably up quite dramatically in terms of people looking to buy. Our gearing ratios across our entire client portfolios are quite low. So our clients are actually buying, and looking at these kind of residential markets and seeing that there are opportunities in segmented markets nationally. So if you look at the capital city vacancy rates, they've actually worsened since the last time we had this discussion and presentation. You can see right now, of all the capital cities, we're still sitting at a vacancy rate of sub 2%. Melbourne, Sydney, Perth's getting worse. So we're seeing strong amounts of overseas migration inflows coming in, but we're not building enough stock to cater for that demand. So we've seen pretty significant rent rises for our clients that own assets in Sydney, in both housing and units. We're seeing pretty significant increases in the unit and housing sector here in Melbourne as well. So nationally, across the group, we're actually advising our particular landlords that own really good quality residential housing to increase their rents by anywhere between 8 and 15%. We haven't seen significant rent rises for a good 6 or 7 years now. So I think this year is going to be the year of the rent rises, and we're actually going out to our client base and really, when we're doing their annual reviews, looking at their individual assets and seeing if there's an opportunity to increase those rents. Regionals, Bendigo, Ballarat, Geelong, we've probably seen vacancy rates for Geelong increase slightly over the last, say, 3 to 4 months. So we are seeing some easing in terms of seeing that market probably stabilise. But the other regionals nationally, we're still seeing vacancy rates, sub 1.5%, really, really strong at the moment. So we probably expect some of those regional rents to continue to rise. But we're seeing a slowdown in terms of some of that buying activity in areas like Bendigo and Geelong in terms of housing supply, and obviously builders out there with those new land subdivisions opening up, not being able to build, which is a bit of a concern to us. So we're just tracking those regional markets closely. But areas like Toowoomba, Rockhampton, areas that we're buying in, those vacancy rates are actually being lowered. So we're probably expecting still some reasonably significant uplift in some rental growth in those areas. This is the big one for us. You're seeing obviously a lot of these larger builders actually going bust at the moment, and a lot of commercial builders. There's talk of another 2 commercial builders here in Melbourne and Sydney going under over the next few weeks that we've got some information on. So at the moment, nationally, we're probably undersupplied in terms of both for housing and units, roughly around 183,000 people or housing stock. So if you look at the housing sector and the unit sector, we're sitting in roughly around about 184,000 people, houses short on accommodation. So that's not getting any better. We're actually seeing, obviously, overseas skilled migration has probably outperformed our expectations. We're expecting roughly around about 200,000 people to come into the country over the next 12 months. That's been up towards 300,000. So that's significantly higher than what we're expecting. So if we're not building enough stock to cater for that particular demand at the moment, that's a really big concern for us at the moment. So that's going to put further pressure on rental accommodation nationally. You're going to see pretty significant rental increases across the board for both units and houses. So if you've got any stock or any of your current investments, I would strongly advise you to review that rent and actually increase them quite aggressively this year. And it's probably more around hedging that interest rate movement. And if we do see another couple of increases, I think that rental growth that we're expecting will probably hedge that out. So the next 1 or 2 years, we're probably expecting in excess, we're expecting around 600,000 to come in, but that might outperform our initial expectations. So it's really happening at a really rapid rate and a lot higher than we originally anticipated 6 months ago. Investor versus home buyer lending, we're actually seeing a decline in that, but we're expecting that. You can see there's been a little bit of an uptick in terms of maybe it's suggesting people are getting used to obviously where the interest rate and the cash rate is sitting. And there might be some stabilisation across some of these residential markets across Australia. So we've seen a slight uptick since the last time we ran this presentation, but it'll be really interesting to see what happens over this next quarter for both investor lending and owner-occupier lending. We'll touch on Brisbane. Initially, we've got a lot of clients that own investments in Brisbane. You can see the affordability index hasn't really changed since the last time we did this presentation. It's still running at 45%. We saw a slight decline last year, but we're probably expecting that to stabilise and possibly seeing, there's not a lot of stock available in the market to sell at the moment. So average days on market hasn't increased, which is probably a really healthy sign that there possibly could be some reasonably good uplift in that Brisbane housing sector over the next 12 to 24 months. You can see the price to income ratio for housing has probably come off a little bit as well. So it was 8.4, now it's running at 8.1 times income. And if you look at units, it's still running at 5.2 times price to income ratio at the moment. At the moment, we probably see a little bit of a fall in the housing sector in Brisbane, but we probably expect a little bit more that to stabilise and a little bit more uplift in the short term to medium term. Is our kind of current view on the Brisbane housing sector. You can see that the median house price and the median unit price, there's a nice healthy gap there. So I think the pricing of units, we probably expect some uplift over the next 12 to 24 months. But there's definitely been some stabilisation in the housing sector at the moment. And we're seeing some really good prices now being paid for the housing sector in comparison to this time last year. So that stabilisation period and that confidence back in that Brisbane market is starting to, we're seeing some evidence of some, some reasonably good uplift in the short term to medium term. Household lending, you can see here, so since the last time we spoke, it was coming off, but we've actually seen a little bit of uplift for some investor lending and owner-occupier lending. So a little bit of positivity back there in the Brisbane, housing sector. It's probably stabilised, and people are starting to take on a little bit more, owner-occupier loans to go out and buy their house. And we've seen a little bit of an uplift in kind of investor lending, which is a good sign. This is the big one for us. There's simply not enough stock, to cater for that incoming demand for Brisbane. So stock levels at the moment, there's only 18,000 dwellings on the market for sale, and an average house is taking 21 days to sell. So it's really, from that end, if we saw the days on market starting to increase, we'd actually have some concern there. But there simply isn't enough stock to cater for that incoming demand. And with the heavy amounts of skilled migration coming back into the country, it could possibly have the reverse effect, and we possibly could see some price growth in the short term to medium term in Brisbane. Again, since the last time we ran this presentation, vacancy rates have worsened in Brisbane. So the vacancy rate at the moment, it was 1.1%. It's now down at 0.8%. So for both houses and units, we're really seeing an increase in rents for those. So what I'd strongly advise, if you've got assets in Brisbane in the housing sector or the unit sector, I think now's the time to really go after that rent and try and increase it quite aggressively if you can over the next 12 months. Job vacancies, we've probably seen that slightly stabilise over the last, say, month or two. Not a concern to us, but there's plenty of kind of private job vacancies available and public sector as well. But in the private sector, the unemployment rate and the underemployment rate is extremely healthy for us. So, Brisbane's kind of ticking along really well. It's actually gotten through that very difficult period of the floods and some of the storm damage that it's gone through. Melbourne, we'll quickly touch on Melbourne because a lot of clients are actually asking this question around Melbourne and where it's going. It's, we're probably seeing pretty strong evidence of trade shortages across the state. And that's due to the large infrastructure rollout from the Victorian government. So it's been really hard to get trades for our clients to do any renovations, domestic renovations, even commercial renovations or CapEx requirements on our commercial buildings that we're buying. If we're looking at overseas migration, that's really pushing this export education sector here in Melbourne. And any clients, again, that own any units and houses, we're probably expecting some pretty significant rises this year. Our department head manager, Amy Fiss, that runs our department here in Melbourne for our kind of residential rents, she's increasing her rents quite dramatically, and after no kind of rental increases over the last 2 or 3 years. So she's doing a really fantastic job going out there, analysing each of these individual houses and units and really increasing those rents, this particular year. We're seeing really good quality housing still move. There's still buyer depth in that $3 to $5 million range. So if it's a good quality asset and it's renovated, there's probably been a lot of demand for that particular sort of price point. Where I'm starting to see a little bit of opportunity at the moment is in that 5 to 12 mil range. So some of the eastern suburbs markets, some of the Bayside markets, we've been acquiring a bit of owner-occupier stock through BuyerX, our other business. And our team on the ground are actually aggressively buying some of these assets where that competition probably isn't quite as strong as probably what it was 6 or 12 months ago. We're seeing some really good entry-level purchases for clients that are taking a long-term view in that $1 to $2 million price bracket here in Melbourne. And they're areas like Carlton, Kensington, Flemington. So really good quality city fringe that are backed by the hospital and university there. We are seeing some opportunities starting to evident, but we haven't been able to look at those particular assets for some time. So they're starting to come out of the woodwork for the first time in a while. Affordability index in Melbourne, you can see that when Melbourne hits an affordability index of around about 54, 55%, prices tend to get capped out. You can see over the last 12 months, prices have actually come off slightly. But we're seeing that it's probably at its all-time of affordability index. But, you know, over the next, say, short term to medium term, there could be good opportunities to start considering over the next 12 or 24 months. Price to income ratio is starting to come off as well slightly in comparison to Sydney. So it's running at 9.4 times income. And if you look at the price to income ratio for units, it's running at 6.4 times income as well. Median house prices, you can see Melbourne's been a brilliant performer all the way to basically early 2000s. It's gone from 197 to 395 in 2008, all the way up to, say, 875. So there's been a little bit of a drop off here. And, you know, during COVID, we probably expected prices to stabilize. So we're probably going through those normal conditions that we probably were expecting to happen 2 or 3 years ago. You know, differential, I think units will probably definitely go on a little bit of a run at the moment. We're simply not building enough high density stock, medium density stock. A lot of these builders can't generate any returns in terms of the projects that they're running. They can't get funding for them as well. And the margins simply just aren't there for a developer out there to build stock at the moment, really good quality owner-occupier residential stock. So you're going to see an undersupply starting to become evident in both Melbourne, Sydney, and probably along the east coast of Australia in the next few years, which will probably have a positive effect on any stock that's established out there. With, you know, we probably could see some uplift in the short term to medium term. Household lending, you can see it really dipped for both houses and, you know, for investment lending and owner-occupier lending. But again, there's a little bit of an uplift now starting to appear for the first time in a while. So it really started to come off, but there's evidence of a little bit of an increase in people saying, well, okay, is now the time to kind of jump back in? And that's going to be a really interesting 6 months to see how, you know, how many people are getting home loans and going out there and getting back into the investment markets again. Right now, it's kind of stock levels, you know, days on market hasn't really increased too dramatically. So stock levels for inferior kind of main road or compromised stock is still evident. But, you know, to have a healthy market here in Melbourne, we need roughly around about 40 to 45,000 dwellings available on the market at all times. There's simply not enough stock there. So average days on market is running at 27 days for an average house to sell. So it's still relatively healthy and stock is moving. But people that have taken on way too much debt within their personal borrowing capacity, they're the ones that are actually selling some of this compromised and main road stock. But good quality stock, owner-occupier stock, you know, in that anywhere between that $2 and $5 million range is still selling really well. And I'm still seeing some premiums being paid for them currently on the ground at the moment. Vacancy rates worsened again. So rents are now $645 for an average house at the moment. Vacancy rate's sitting at 1.1%. So again, units and houses, rents are rising. That's a real positive, you know, view for any clients that own any residential stock. So Amy, again, doing a brilliant job here in Melbourne and really getting stuck into each of those individual houses and units, increasing those rents for our landlords at the moment. Job vacancies, we've seen a little bit of a dip in job vacancies at the moment. There's been an increase in kind of public job vacancies, but we've seen a little bit of decline in the private sector. So some of the larger corporates are definitely looking at, you know, the number of employees and looking at their inefficiencies and cash flows and assessing whether or not, you know, whether I need that amount of staff to kind of run the business. So we still expect that to happen over the next 12 to 24 months as well. So this is very much a watch and see space to see where that goes as well. Perth, as you all know, we've obviously been very, very active in Perth the last 2 to 3 years. The affordability index isn't getting any better. You can see right now, well and truly under its long-term affordability index of around, say, 40 to 50%. You know, when the affordability index hits around 50% in Perth, we can see prices get capped out. So there is a lot of uplift we expect in that housing sector in Perth over the next 2 or 3 years. So you can see it's a very volatile market. It kind of goes through these very significant uplifts, but the last, say, 13, 14 years, there's been very little growth, and we're starting to, for the first time in 2 years, we're roughly around about 20% up on the assets that we've purchased to date. But we still see some fairly significant uplift in the housing sector at the moment. Price to income ratio, very attractive for us. It's running at 5.5 times income for a house and 3.9 times income. Not really buying any units in Perth, but for the housing sector, that's predominantly where we're concentrating on, and seeing really good opportunities in that housing sector between 800 and 1.5 in AAA rated suburbs at the moment. So aggressively buying over there and taking a very strong position over the next, say, 12, 24 months in that market. At the moment, you can see that, see right here, obviously a sustained period of no growth, but we're starting to see some uplift in the housing sector. And, since we started, we're seeing, the average kind of median go from 500 to 570. So we still see the next 3 to 4 years in Perth as being very attractive to our residential investor base. There is a very small gap between the prices of houses and units. So again, we probably expect houses to go on a little bit of a run. Owner-occupied lending, again, a little bit of uplift and a little bit of, renewed confidence out there. Not significant, but, a lot of people out there buying homes, and there is a bit of an increase in investor lending. There's an increase there, which is a real positive for the investment markets and owner-occupier markets at the moment. Stock levels are really, really low for Perth. So you can see when Perth obviously had average days on market at 58 days, there were 25,000 dwellings on the market for sale. At the moment, there's only 19,000 dwellings on the market for sale, and average days on market is 16 days. So as soon as a real estate agent is listing a property, is selling in 2 weeks, it is really moving. That buyer depth is extremely strong. So, a majority of the assets that we're buying for our clients are off market currently in Perth, because we can't compete. As soon as they go on the market, there's serious premiums being paid at the moment because of that demand is actually very, very strong. Vacancy rates have worsened again in Perth, so that stock shortage is not getting any better. Rents are rising. The vacancy rate is sub 0.5%. So, we haven't seen it this low in our time looking at the data sets for over 20 years in terms of the vacancy rate over there. So extremely positive, very, very strong rental growth expected over the next 12 to 24 months for both. Not so much units, but definitely in the housing sector, we're not seeing that slowing down. Job vacancies, both private and public, a little bit of a dip, but nothing too concerning. There's still kind of 50,000 kind of WA job vacancies in the private sector, which is probably what we want to track. And we're also tracking the commodity sector as well to see how that's going, but still fairly positive at the moment. Sydney, we've got a lot of clients. When do we jump back into Sydney? You can see the affordability index has kind of slightly eased from, it was 76% last time we spoke. It's now down to 74. So it's suggesting that it's easing, but, from our end, we wouldn't be investing in Sydney right now. We know when Sydney has an affordability index of around 65 to 67%, prices are capped out. It's still running at 74%. So we still expect some price contraction in the housing sector. And you can see the price to income ratio for housing is eased, which is good. It's a good sign, but still fairly high in comparison to the other capital cities. So a lot of the other capital cities represent far better value than Sydney right now. We've seen a drop off in the median price in the housing sector. So we think it's going to ease around about that 1.15, 1.2. And then that correction period will start to stabilize, and it'll go through that stabilization period. So, on the clock, we probably see it, at around about that 3 o'clock on our clock that we'll kind of touch into a little bit later. You can see the differential between units and housing. Again, I think units are probably a little bit more affordable, but I wouldn't be touching housing in Sydney right now. Owner-occupied lending, investment lending's really dropped off. But again, a little bit of uplift there. So you can see there, there's a little bit of evidence in there in terms of potential uplift at the moment, but we're not seeing, an opportunity in the Sydney market right now for our investors. Stock on market's increased. So stock on market's gone from, say, 25,000 to 27,000, and average days on market's running at 30 days at the moment. So hasn't particularly moved. When we see those average days on market starting to increase, that's a bit of a concern, but a little bit more stock available. Vacancy rates, again, excellent. Rents, probably seen the biggest rental uplift or increase of all the capital cities over the last 12 months. Rents have gone from, $886 since the last time we spoke to $936 for an average house. So we're seeing stories of people, of landlords increasing their rents by 30, 40%, not 10 or 15%. So there's been some really aggressive rental increases on the ground. And some of these landlords are actually achieving them. So they're being ultra aggressive at the moment with their rents. We've seen interesting uplift in terms of job vacancies at the moment. So that's a real positive at the moment that, things are holding up in Sydney at the moment. And you can see this is obviously the clock, and we always touch on our clocks and cycles in terms of, the capital cities take anywhere between 11 to 14 years to go through that full cycle. And the regionals take anywhere between 14 and 17 years to go through that full upswing and downturn as well. So when we're looking at the clocks nationally, you can see that Sydney, is nearing towards that stagnation period. And as you know, we grade every suburb in Australia as a AAA, triple B, triple C or triple D. You can see that we've kind of moved Brisbane slightly back in terms of our review last time. Adelaide's a little bit further ahead. You can see Perth is definitely in the middle of that buy value stage, and areas like Toowoomba and Rockingham and Rockhampton, especially Rockhampton, we're seeing a lot of evidence on the ground of really good buying opportunities between that probably 450 to 550K. So really good entry points. And we've kind of moved into Rockingham and out of, Bendigo and Geelong and really taking a position on some of those Queensland regionals that are probably offering some pretty significant value for our kind of entry-level investors looking to buy their first asset and starting to build their portfolio out. For units, again, the unit market is quite different to kind of the housing market. I think probably you can see the Sydney market's a lot different in the unit market to the housing market. So Sydney and Melbourne are probably in that buy momentum phase at the moment. And as we move into more of an undersupply, that could actually move into that lower end buy value or even buy momentum phase. So it's in between that hold rating and buy momentum, but that could actually come back further as we move into a bit of an undersupply. Commercial, our commercial team on the ground are very, very active. We haven't seen our commercial team this active for about 3 years. So obviously the inflation versus cash rate, the cash rate's still sitting at kind of 3.6, and we're starting to see the inflation rate kind of starting to ease, but I think we've still got a fair way to go in terms of seeing that starting to come off even further. So it's very much a watch and see space in terms of where that kind of settles down over the next 6 or 12 months. At the moment, in terms of our views and our probabilities, in terms of our forecasting nationally, in terms of if we see some further movement in terms of the cash rate, you can see that areas like Brisbane still have a little bit more uplift, even if the cash rate goes to 3.85, which means your variable rate will sit around about 6.1%. So there's still a little bit of uplift in Adelaide. There's still a little bit of uplift in Brisbane. Darwin and Perth markets kind of operate at very similar cycles. So you can see that Darwin is actually starting to represent really good opportunity within that, say, $800,000 price point, $800,000 price point. You can see that Perth's got a little bit more uplift as well. And I think Melbourne's going to hold quite steady, and Canberra's going to come off quite, just slightly, I think. But if you look at the regionals, across, there's still a little bit of uplift, even with another interest rate or cash rate increase at 3.85 for Bendigo and Ballarat. Geelong is getting a little bit toppy in terms of starting to stabilise. Toowoomba, Ipswich, Rockhampton, areas like Sunshine Coast and Rockingham still have some reasonably significant uplift. So those are the areas we'd like our clients to kind of concentrate on over the next 12 or 24 months, if possible. The commercial update, we probably saw a 6.8% increase in terms of the total return over the last 12 months. Q4, we probably saw some negative growth in terms of transaction volumes were well and truly down by about 66%. So usually there's a 6-month lag in terms of seeing those volumes coming through in terms of what we're analysing as a business and looking at those data sets. We've seen kind of total returns for industrial and healthcare sectors, which have probably been the flavour of the month over the last 3 or 4 years. They're starting to soften, which, our team on the ground have actually increased their buying, and we're actually seeing a lot more opportunity on the ground for assets between that 3 to kind of 10 mil price point for our private clients looking to buy really good quality commercial and industrial property. Retail returns have been fairly steady. We've slowly started to see a little bit of an increase. So the 1-year returns are probably slightly above the 3 and 5-year returns, which is probably a positive view in terms of where we're seeing those markets move. So I think from our end, we're definitely a lot more active in that commercial industrial space and buying a lot more assets between that 5 and say 6.5%. We're waiting for kind of these vendors to ease some of their yield expectations and pricing in terms of where they saw the value sitting at. So we're seeing a lot more opportunity for the first time in 12, 24 months. I think, from our residential advice, we're advising our clients to make the most of these next kind of 18 months. Adelaide, Perth, Toowoomba, Rockingham, Rockhampton, and even Brisbane, to a lesser point, there are still really good buying opportunities, and we are buying a lot more stock within those markets. So we're definitely advising our clients that have a little bit of a cash buffer there to look at growth and income. And obviously look at our property fund that we're just about to launch, or we have launched. We're looking at obviously a little bit of consolidation into those and balancing their portfolios out. So from that end, in terms of the industrial and the commercial yields nationally, we're seeing a little bit of easing in that particular space at the moment, and we are seeing a lot more opportunities than probably what we were anticipating 12 months ago in that commercial space. So medical, healthcare, even allied health, we've been buying a few assets there, seeing some really, really good industrial opportunities in probably outside of Melbourne and Sydney. So Adelaide, Perth, Brisbane, we've been buying a lot of stock. So our team on the ground have been securing a lot more assets within that sort of 3 to 5 mil price point. So I think this is going to be the year for residential to increase your rents. If you've got any assets within your portfolio that need to be reviewed, when we're doing your annual review, and we have our senior team looking at your personal position, this is the year to actually increase those. We are obviously focusing a lot more on really good quality regional opportunities and capital city opportunities, but more so in the regional and concentrating on those commercial assets. We've got a strong advice to continue to hold your growth-focused assets in most capital cities across the country. If you're in Sydney, there's probably an ability to kind of recycle some of that debt and pay down your principal place of residence debt. But from our end, it's definitely a hold rating and continue to hold those growth-focused assets in those markets. In terms of recent purchases, I'll take you through a couple of assets. This was one that we purchased for an SMSF client. This was in Rockhampton. So this is an example of an asset that is fully renovated. We bought it for 505. It's on a 640 square metre block. It's getting $650 a week. So $650 a week for a $505,000 asset. Block size was good. It was fully renovated. And that was obviously a really nice little established home in a good suburb of Rockhampton. This is an asset in Rockingham, which is the Frankston of WA. We purchased this for $530,000. It was on a 700 square metre block. Really good kind of estate style home in a triple B rated suburb. The yield on it was 5.2% gross. And it had a really good block of land. It was kind of fairly neat and tidy. This was a typical example of what we're buying in Perth. So a really good quality period home. And you'd really struggle to buy this in a Melbourne or Sydney suburb for about $1 million. It was getting $40,000 a year in income. Really good quality suburb. Great size block at 500 square meters, less than say 10 kilometers out from this, Perth CBD. So 4 beds, 2 bathrooms, 2 living rooms, good car accommodation as well, and fairly neat and tidy. Not a lot of work to do internally. This was another asset. This is more of a development play, but you can get a really good holding income on that asset, sub 1 mil, on an 820 square meter block, and you can retain the house as well. So again, really good quality suburb, sub 1 mil. I think there's some really good buying opportunities in that sub 1 mil space. Toowoomba development play, 1,000 square meter block, 525,000. Yield was just under 5%. In an area, obviously, where the hospital's obviously being built, so that'll be finished in 2027. But a really good entry-level opportunity for an entry-level investor. This is an example of something that we purchased for a client that was more of a passive investor. This was the police headquarters over in a suburb over in Perth. We purchased this for 4.3. We had really long-term lease tenure on the building. Had 48 car spaces, fairly modern building as well. Good height clearance as well. So a really good quality investment for a client that had a $5 million budget that we picked up for 4.3. This was an example of, really, really good quality commercial investment. This was for a client that wanted to look at an asset with some development uplift in the medium term. Now, we purchased this for 3.5 mil. They're getting some holding income on the asset, but, the kind of end exit strategy with this is actually developed to 3 to 5 levels on this particular building. So you can get some holding income on pretty significant assets with some development uplift in that sub 5 mil range. So again, individual investor purchased this. Some mixed retail in the building, but great block of land in Albion, which is less than, say, 6 kilometers from Brisbane CBD. This is an example of more of an entry-level investment. Allied Health tenant, really long tenure. We purchased this for kind of 1.38 mil. We're getting $70,000 in income. Again, what we really liked about this investment, it was on 900 square meters, main road frontage, the ability to kind of develop the asset in the medium term as well. So there are commercial assets that you can consider between 1 and 3 mil. And our team on the ground are actually buying assets within that particular space as well. But this was a really good quality entry-level investment. This was another asset that we just purchased recently for 5 mil. Really good industrial site, long-term lease tenure. Picked it up on a 6.26% yield. Some pretty significant uplift, great ceiling heights internally. And we had a long-term tenure and a great tenant, 50 car spaces on that particular building. So some really, really good opportunities starting to present for the first time in that commercial space at the moment. Now, I'll touch on our performance property income fund that we've just launched. So quick disclaimer, this advice is general and does not take into account any of your objectives, financial situations or needs. You should consider whether advice is suitable for you and your personal circumstances before you make any decision about whether to invest in our fund. You should obtain and read the IM, and you can reach out to Megan at our office. But essentially, what it means is we're going to target a fund size of around about $10 million. We'll be looking at very similar assets to the examples that I just touched on before. The investment term is going to be 7 years. We've got a target annual rental yield of around 6.25% with 3% annual increases. And we're targeting growth on that particular asset, capital growth of around 4.8% per annum. So the minimum investment's around 200K, and eligible investors are wholesale sophisticated investors only. So to give you an example, we did 2 over the last, say, 18 months. We purchased a really good industrial site down in Tassie for about 8.2. We bought that on a yield of around 6.6%. But the goal of the fund is to look at established, really good quality commercial sites in that $3 million plus range. We're looking at long-term leases on the particular building. We're looking at really reputable tenants in the healthcare space, government space, stable industries. The other asset that we purchased recently was a Centrelink office. It had 41% site coverage. We bought it on a 5.4% yield, but great particular tenant. And we're just kind of reviewing their lease in terms of trying to increase their tenure for their next year option up to 7 years rather than 3. So if you do want more information on our income fund, reach out to Megan in our office and she'll send you through the IM for you to review. But I think that basically finishes up the presentation today. If you've got any questions, kind of reach out to any of the senior advisors, and thanks for your time.